Joining me now is Richard Lacaille, Global Chief Investment Officer for State Street Global Advisor. Richard, thank you so much for coming in. It must be quite difficult to navigate the markets in terms of, how much exactly quantitative easing will have an impact on what sectors. I mean, how do you make of all of this? We have a huge week coming up.
Yeah, we do have a huge week. Well, quantitative easing has been baked into prices for quite some time. Will it have an impact on where, perhaps politicians really want an impact, which is mid and small-sized companies, credit creation for the consumer and confidence in the economy? It could do. We've already seen a crushing of yields. We've seen refinancing rates on mortgages come down a lot, putting money into people's pockets. So it will have an impact. But will it be enough for some people is another question.
So what does it mean in terms of the sectors that may actually benefit from extra quantitative easing? I mean, the other side of the coin is that the G20 pledged not to go into a currency war, but we're going to see competitive devaluation no matter what.
Well, currency wars are out there. I mean, if you look at the volatility of currencies, the currency wars haven't stopped. And I think you've got actions taken by some emerging market countries to try and limit capital inflows. So I think it's easy for the G20 to make those statements, but actually put it into practice has proven to be politically much more difficult.
Give me your top tip, Richard. I know you're a guru in the financial markets. I mean, what is the hot place that investors can make a little bit of money given the volatility in terms of, the headwinds of the global economy?
Well, I think we don't want to overreact to QE either way. QE is going to have an impact. Is it really necessary? I think there's a number of people who ask that question because we still do see growth in the economy. There's quite a lot of fiscal stimulus left, and for that reason we think corporate assets are still good value. So credit may be a little bit more attractive than equities. Large cap equities are a little bit more attractive than small cap, and particularly non-US equities and European small caps, for example, might be more interesting than US small cap.
What about the emerging markets? I mean, where do they stand? More attractive than the Europeans, or?
Well, yes, the valuation discount has disappeared out of emerging markets more or less completely, but you are still seeing very strong growth, and that's feeding through into European earnings numbers of European companies. And although you've got these capital controls or squeezes going on in emerging markets, that growth pattern still seems to be continuing because you've got incredibly loose monetary policy transmitting itself around the world.
Richard, how much do you look at actually earnings? And, we have these forecast-beating estimates and forecasts, but they don't seem to be translating into higher prices for equities. Is this already been priced in, or is it just a bit of cost-cutting, so not real growth that you're seeing?
Well, earnings, and particularly sustainable earnings, are an important part of our investment strategy when it comes to stock picking. I think what you've seen in the last round of results, or this round of results, is earnings are beating expectations, not by very much, but a lot of it's coming from cost-cutting as opposed to top-line growth. So top-line growth has been okay, but it's not been outstanding. And so I think there's a limit to how much that cost-cutting can go on. If you look at what's happened in the US, productivity growth started to peter out. And so you've got to rely on other engines to move the equity market forward.
What about consolidation? Does that play a factor in how you asset allocate? I mean, we speak to a lot of private equity guys, and they say, by here to the end of the year, we want to make deals, but they only have 2 months left.
Well, there's a big cash pile left. I don't think we should put all the emphasis on private equity. I think investors have already rewarded companies for making acquisitions, which is rather unusual. Often, when companies make acquisitions, the market punishes them. I think investors see that cash pile and they see management confidence building as they make acquisitions. There's a number of brokers are putting out notes on the subject, and I think you might dismiss that as a bit self-serving coming from investment banks. But nevertheless, I think within industry, consolidation makes a lot of sense for shareholders.
Richard, what about corporate bonds? I mean, they had a fantastic run. Is this another way of getting into the market of companies but being a little bit safer?
Well, we think the value in corporate bonds may be at the sort of crossover and high yield level rather than in corporates. I mean, you're right. Spreads have been squeezed incredibly tight, and further quantitative easing again will squeeze investors into those spread markets. But if we look through that to default risk, and particularly if we think the economy is not going to have a double dip, then we think high yield are still reasonable value.
Richard, I need a one-word answer. Double dip, yes or no?
We don't think there'll be a double dip.